Are there reasons to love Bank of America's stock, or at least tolerate it? Jack Moore, Director of Research for Action Alerts Plus, is here. Jack, it is the stock everyone loves to hate right now.
Yeah, no, I mean, it really is so easy to hate, and I think that it's an easy target. But I think that what people are doing is they're taking the Bank of America of last year, which really was a crippled bank, which had serious governance issues. They had serious just issues with their capital and their business model in general. They failed the stress test results, and they're trading that as if the bank is still in that crippled state, and it's not. And they're also, if you look at how the bank is trading on a valuation basis, it's trading at about a 20% discount to the tangible book value. So really, literally, if you liquidate all of its assets, what it would be worth that it reported in the fourth quarter. Now, even under recessionary, if you assume an economic recession in the US, this bank can still grow that tangible book value. Under more normalized circumstances, it can grow it to $17 by the end of the year. So then you're looking at it, and you have a $13 stock price. So that implies a 27% discount to its tangible book value. So I think that regardless of, you can make any underlying assumption really in the economy, and you can say that our economy is going to be in a recession, and Bank of America is still undervalued. And if you look at it, it's trading, at even a bigger gap to tangible book than it ever has in any of the recessions in the early 90s, the recession in the early 2000s. So it just doesn't make sense. And they've made an incredible amount of progress from a regulatory perspective and from a capital efficiency perspective.
So obviously this message is not getting to the street. Where does it seem to you a more comfortable valuation is for Bank of America stock?
I think more comfortable would be around $15. I think that makes sense. I mean, I think that's still a pretty decent discount to its tangible book value that still bakes in some residual overhang from the regulatory difficulties it had in the past. And I think long term, $17 is very realistic, because it should be trading closer to where its tangible book value is, or at the very least, where the tangible book value is going. And the fact that if you look at it from a funding perspective, its deposits as a percentage of total assets, its deposits versus loans, and also from a capital perspective, its return on common equity and its capital, ratios are just tremendously stronger. And the final thing I'd say is that the bank has more capital flexibility this year, and they can double their buybacks, double their dividends, and over the next 3 years, they can triple their buybacks. Over the next 4 years, triple their dividends. So I think that when you're buying back your shares at such a big discount to tangible book, it's immediately accretive. And so I think that it's a very easy argument to make that, sure, their top line isn't growing as strong, right, and sure, Brian Moynihan, their CEO, has some credibility issues, but at a certain point, you have to see whether that is really fair to trade it as if we're in an economic recession.
Some great points. Jack Moore, thanks so much.
Thanks.
I'm Rhonda Schaffler for The Street.